Welcome back. You're watching Stockwatch with me, Zinati Guma, and joining me to take your stock-related questions tonight, Alex Duys from Umthombo Wealth and Drikus Combrinck from Capicraft. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS on 41392 or on X using the hashtag Stockwatch. Thank you so much for your time, gents. Let's actually start off with the negative sentiment that we saw. Alex, starting with you, could we just peg all of that on the disappointment that we've seen from investors on Microsoft and Meta?
Hey, good evening. So October has been a bit of a disappointment in the markets, a sort of a pullback, but I think it is necessary. The market's been very strong this year. We've also had a very strong Q3, so I'm not too surprised by that. Looking at the results, I actually thought Meta's results were actually quite good in my view. I think the business is relatively well positioned. We saw pretty much record revenues from the business, good margins, a decent free cash flow generation. So I think they're relatively well positioned. I haven't had a chance to go through Microsoft numbers yet, so unfortunately I can't comment on that. But I think these valuations are relatively high, right? So if they don't hit exactly or actually surpass broker expectations, then there will be a bit of a pullback. But I do think a pullback is healthy at this moment.
Yeah, it's quite interesting because an analyst that I spoke to earlier on also said that he didn't really understand the market's reaction at this point. Drikus, do you think that there is an overreaction here?
No, I think they're ridiculously expensive. I think Microsoft is sitting at a 2.5% free cash flow yield. So is a lot of the others. That's before accounting for stuff that doesn't go through the cash flow statement, like share-based compensation, where there's a net issuance of shares. It's not as pronounced as it was in previous years, but it's still an issue. So no, I think they're ridiculously expensive, overhyped. And yeah, I think Alex is right. You know, a healthy pullback, maybe another 20%, and I might I might look at them again.
Well, still in tech, there's a specific question here on chip makers, AMD and SMCI. There has been disappointment on the two companies, and I do note also the fact that there was disappointment, was it with TSMC, if I remember correctly, or there's so many chip makers. But Alex, what do you make of these? And actually, the specific question is your view on these stocks, especially SMCI, after plummeting over 20%.
Yeah, we're going to hand over this to Drikus. I don't look at this by professional capacity. Obviously, I feel my personal capacity, but none of these. So I'd rather hand over to Drikus.
Drikus, your take?
Yeah, so the problem is who was the auditor of MSCR did not come out yesterday with, in defense of the company. And there was a letter going around where they basically agreed with, I think it was with the SEC, I can't remember. And I think there's a problem with regards to the quality of earnings for the sector. There's a lot of round tripping happening, especially at Nvidia. Look, it's not going to break the growth story. I still think there's a AI story. Overhyped, sure. I don't know. But there's still something concrete there. Every bubble is built around something that is real and fundamental, and it is there. But I do think there's a lot of foam on this cappuccino that needs to be blown away before we see what the color of the coffee is. So, yeah, I think that's the problem. Quality of earnings. There's a lot of questions being asked, rightly so. And, yeah, let's see how much foam there really is. I think we're in for a bumpy ride for the NASDAQ over the short term. I think higher yields brings people back to some sanity. What we saw today is that the US economy is still resilient, and that even though the PCE deflated, the personal consumption expenditure, basically the inflation gauge that the Fed uses, is come down to about 2.1%. The core figure is 2.7%. So that's lower than any figure that we've seen over the last 12 months, but it's still way above 2%. and the Fed is willing to cut into that. I think that's why we saw rates came down the last month or so, but I think the market is also saying, wait a minute, I don't think the Fed is going to be so aggressive in cutting rates that we thought a month ago, and we see short-term yields moving higher this morning. And yeah, that's healthy. That's healthy for the market.
ASML is the chip company that I was looking for earlier.
Oh.
Just, I mean, with obviously the pressure and the disappointment that we've seen from investors on these chip companies, looking at, of course, we haven't gotten Nvidia results yet, Alex, but really having been the market maker and the market breaker, do you think that we could see that filtering through and that there's a risk of the markets taking a very big knock here when we get those results?
Oh, I don't know, but think about Nvidia. The numbers that are expected to generate or have generated recently are mind-boggling, really. Right? So if we look at the revenue numbers and actual profitability numbers, it's enormous. I mean, numbers South African investors we can't really comprehend, right? So I concur with Drikus. There's certainly a growth theme there, but how sustainable it will be and to what extent it's going to be, it's very difficult to say. And the market's obviously penciling some very aggressive numbers there. So any form of disappointment, specifically on guidance, the shares will be hammered. But saying that, if they are maintaining guidance, then most likely it will continue. So it's very difficult to say at the moment. I think if you are on shoulder in your portfolio, just manage your position, right? Perhaps be careful not to have too much position, because if things do go wrong, American markets move very quickly. So things can move very quickly. You might take a break for a week or two before you know it, half your portfolio is gone. Yeah,
we're talking about a hammering and things going wrong. Sasol is below 100 at 98 Rand. The question goes, I have invested 1 million Rand into Sasol at 112.50 per share. Should I take a loss now and sell, or wait for the China stimulus and US elections? Alternatively, should I average out and purchase more shares at 98 Rand? Drikus.
Yeah, as a general rule, don't throw good money after bad money, unless that was your strategy from the beginning. So when I buy into a cyclical story or a capital cycle story, you do realize that, going into something that's contrarian, you need to have time on your side and you average in. So if that's your strategy from the beginning, then yes, 10% lower. It's not too, what's it, 13% lower than the US original buying price. Not a bad time to average in, depending on what your strategy is. But if the million Rand was all the risk you were going to take on Sasol, then no, don't shift the goalposts. Don't put in another dime. So yeah, that's the first rule, or trading rule, position sizing rule, maybe. But I do think sentiment is bad on Sasol, much worse than I think the company maybe deserves. We've got new leadership there. We're not sure if they're going to deliver the previous. Not to say that the previous management teams have delivered. There's just been a 20-year train wreck with regards to capital allocation, and the market has deservedly thrown them the worst rating maybe globally for chemical companies at this moment. They've got still a lot of debt. It's much better than it was at one time. They've got issues in the coal mining activities. They've got a lot of bad quality coal, and those are easy fixes. Why they're not fixing that, I'm not sure. Maybe over the next 6 months we might get some better action there. And then our chemicals markets are depressed. That will turn if you've got enough time. Does Sasol have enough time? I'm not sure. And lastly is, I do think oil prices are quite depressed at the moment. There's something incongruent with, markets at all-time highs and oil prices this low. Traders are too net short, maybe record net short, or near record net short levels, speculative positions. And with the geopolitical risk premium out of the way for the moment, that's been a sideshow the last month or so. I do see oil fundamental strengthening over the next few months, and then Sasol should strengthen into that with the sector. But it's been quite a tough road for Sasol shareholders. But I do think the low price does warrant a position here.
Yeah, there really have been a lot of lessons that have been learned from catching falling knives, transaction capital being one of them, where a lot of people were catching a falling knife. Yeah, do you think that, Alex, this could be it? Or, yeah, I don't know. I don't even know if I should ask you if you do see a bottom, because I guess nobody knows.
Yeah, I could go with Drikus said. I think he made a very good argument. I do like the fact that the sentiment is so negative towards Sasol. So you don't need much of a pendulum to swing a little bit more positive to see a big movement in the share price. Chemical markets are very depressed, and it's most likely going to remain for a period of time, but we don't really know. Fundamentals might change quicker than we anticipate. Same with oil. But yeah, this stock has pretty much been abandoned by South African fund managers. So that could create opportunity. And obviously foreigners won't look at Sasol, because Sasol is very low quality in the bigger scheme of things. So you need South African investors to really start buying it, or I guess some deep value foreigners. But, if things change, before you know it, Sasol can easily double. I mean, that's the thing about Sasol. This is a cyclical stock. If the stars align, can do 200-300%. If the stars don't align, then there's more downside, yes. So it's very difficult to say. So I concur with Drikus. Manage your position. If you're only willing to invest X amount of risk capital, then don't average down. But if you still got a risk available, then perhaps not a bad strategy.
James, a question for MultiChoice. Is the share price basically being held by the canal deal? Alex?
Yeah, it's not been concluded yet. So obviously there's still time value of money that needs to play out. I haven't read it yet, but I read this morning that Canal Plus has brought out a prospectus. And apparently there is some rumors that they could do a JSE listing. But yeah, there's a lot of pages I still need to work through there. So that's something to look out for. Could be interesting for JSE investors. But other than that, I don't have anything else to add.
Drikus, at this point, what does an investor do, considering that the share price isn't going anywhere at this point, while we wait for the finalization or any sort of direction on this deal?
Yeah, sure. The problem is regulatory. This disqualifies a larger merger in accordance with the takeover regulations, local takeover regulations. So a lot of extra scrutiny. One of the problems is obviously the foreign ownership threshold that's already past 20% of the voting rights. So that's obviously a big issue that needs to be sidestepped. And then the timeline to completion. I think the first indications was that we should have a deal by April. Finalized, so time value of money is not the only thing that's being priced in at the moment. There is, let's call it another 5 or 6% discount being priced in that the deal does fall through. So that probability is also, baked into the price a little, maybe a much smaller probability than say 50%, but there is a probability. And once you take heed of that, maybe the better way to play it is to buy option on MultiChoice and short maybe a option further out the money or something like that. That might be a way to play the transaction.
All right. Well, let's go into more questions. Your view on 91, Alex?
Yeah, it was my stock pick perhaps a show or two ago. So I'm quite constructive on the business. 91 has relatively struggled of late because emerging markets underperformed developed markets. And there's been a lot of outflows into US, specifically the Magnificent Seven type of stocks, right? So I think as soon as sentiment changes and you start seeing emerging markets doing a little bit better and more flows away from passive into active managers, specifically traditional managers like 91, which is actually a global business as well. I mean, they are big in Europe, big in Asia, mostly big in Africa as well. I think, if they can grow earnings from this base, even by a few percentage points, 91 in my view is very, very attractive. So yes, I do think it's quite a high beta option, meaning it's highly leveraged to emerging markets. So I think these levels, good time to buy. Difficult to say when the tide will turn.
Yeah.
So that's the only thing, you can't really time it. But I think for those that are willing to wait, good returns is possible.
Yeah, very, very interesting, the downward trend that we've seen lately. Drikus, would you take this as a buying opportunity?
Well, I think it's a good quality traditional asset manager, but it's expensive actually for a traditional global asset manager, active asset manager. Sitting on a sub 10 PE, I can find you one sitting at 8.7. Um, but I do agree with Alex. I think that the next decade, active management will play a larger role again. The pendulum has swung too far towards passive, and you just need another year or two of bad index returns, which will come, invariably. Sorry for to break it to you, but it will come, and then investors will go back to the tried and tested route of active management, where you invest away from some of the larger caps that has driven this market. It's away from trend investing and a bit more back to what we call mean reversion investing, and value, etc. does do well in this environment, in that environment. So I do think markets will go back to that, but it'll take time. And I do think if you've got an emerging market focus asset manager like we own Ashmore PLC in the UK, I do think they also will do well in such an environment.
Well, a very interesting question is on Lewis and ShopRite. So it says, how is it possible that Lewis can smoke the furniture pipe but not ShopRite? Of course, we know that ShopRite is selling its furniture business to Pepkor. Alex?
I mean, first importantly, within ShopRite's furniture component, it's predominantly appliances they're selling there. And Lewis is predominantly furniture, so there are differences.
Okay.
And obviously more credit sales as well in Lewis, so not like for like. So Lewis have been investing substantially in their credit book, debtors book for over the last few years, and collections has improved substantially since COVID. So this is a very unique combination for them. So they're actually now and of course the high interest rates meant that the book is earning high yield. So this combination of these three things, much larger book, high yield, and much lower, better collections, has meant that earnings growth is substantial, and probably more to come as well. I think brokers will probably have to increase the earnings by anything between 10 to 20% in our view. So they've also gone into a net debt position now, which is not necessarily where they want to be. So I think the cash will come a bit later. And with that cash, they continue to do share buybacks, dividends. And over the last 7 or so years, Lewis has averaged in the region of 15 to 18% if you add the dividends plus the share buybacks, perhaps even closer to 20%. So they have been giving a lot back to shareholders. I think it's been good at capital allocation. And also competition within furniture retail has deteriorated a lot since Ellering's bankruptcy. So Lewis is in a good position. They've got Johan Ensler, the CEO there, that's pretty much started from the bottom. He was like a salesman 50 odd years ago. So no one understands that sector better than him. He's still in the helm. So I think Lewis is well positioned, and it's a stock that's been quite neglected by institutional investors. They have caught up a little bit over the last year or so, but I think you only need 1 or 2 more of these guys to buy, and then there's more upside to come. So we are quite constructive on Lewis. We've been shareholders for quite a few years, and we are not selling at the moment.
Yeah, all right. Drikus, do you think that Lewis has worked itself into being quite a defensive counter?
Yeah, well, it's a good capital allocation story. The difference is that Lewis obviously also a credit retailer, where I do think ShopRite, that's an unfair comparison. ShopRite, I do think they want to stay away from credit. That's not their core competency. I do think Lewis is just as good a credit company as a provider as it is a furniture retailer. And I do think there's, Alex, it's the nail on the head. Competition. There's just not enough competition out there. But once again, you have to balance that credit book with the furniture business, and that's what they do so well.
Drikus, sticking with you, there's a question here on SA bonds. Your view on that on a 1 to 3 year period?
Yeah, I think we are still the interest rate spread above inflation. Real interest rates in SA is among the highest globally, even the highest among some of our emerging peers. I think only Brazil being higher, or around the same levels. And I do think there's scope for the Reserve Bank to, especially after today's PPI figure, to come down with interest rates. What they've done is the last while, let's call it year or two, is they've managed inflation expectations lower. They've communicated that they want to bring inflation expectations from the high fives, almost 6%, down to 4.5, the midpoint, and they're even advocating to go to 3%. Okay, so that's what they actually want, is to move the inflation expectations to the lower part of the 3 to 6% band, and they're even talking about lowering the band. You know, it's so that's where the mind of the MPC is at the moment in the last few years. So unless you change them, which I think will spark pandemonium in the currency, that won't happen. They will lower interest rates as they see that, you know, lower inflation expectations, 4.5 and lower, has been entrenched. Then you'll see real rates move lower, and with that, you'll make a lot of money on longer term government bonds. Those will come down significantly, maybe down to, say, from, I think, the 10 years around 10% at the moment to 8%. That's some capital gain that we'll make there. And we'll probably do that in an environment where the developed world is struggling with inflation.
All right, well, let's go into logistics because we are running out of time. There's a question here on Santova. Santova Logistics, a buy, hold, or sell? Alex?
Yeah, and Santova obviously was an enormous beneficiary when we had COVID. You know, so obviously the rates went through the roof, and demand for product was high and so forth. And since then we have seen, and then they also had the logistical problems with Ukraine and war and so forth. But since then, pricing is more normalized, and you see the revenue numbers have actually retracted quite a lot. I feel for the last set of results, was disappointing. I mean, revenue was down, I can't remember exactly, but the region of almost 20% with profits. So they certainly had abnormal returns. So I think you probably, don't extrapolate historical returns going forward. But saying that, the business, is still relatively well positioned. Balance sheet strong. When they start having normal conditions again, they can grow double digits. They do generate good cash flows normally and so forth. So perhaps if you do like the business, this is not a bad buying opportunity. But not particularly one that I find very interesting. But when the cycle are in the favor, they can actually surprise. They did surprise me last 2 or 3 years. But that was abnormal circumstances. But I think it's a decent quality business. It's a good rand hedge for South Africans that wants to buy something local in the small cap space. Vast majority of its revenues are offshore.
All right, gents, let us get to your stock picks for today. Drikus, what are you choosing?
Well, Absa Group, I can't believe that's coming across my lips. But Absa Group is sitting at a sub-6 price-earnings ratio looking forward, while FirstRand is sitting at 9. I do not expect that gap to close completely, obviously, but 5 to 9 is a big gap. But secondly, if the economy is going to improve, the lower quality bank operator will see a better increase in a rising tide in its profitability than the high quality one, which has done very well in a more difficult environment. So I do think Absa is better poised in the banking sector, and I do think we need a bit of local optimism, in our portfolios, and I try to express that at the moment with my Absa Bank position.
All right. Where are you positioning yourself today, Alex?
Yeah, so I'm going for Pick n Pay. That's obviously a very topical share at the moment with the Boxer listing coming up later. So I think, first of all, Boxer, in my view, is looking very interesting. I think Boxer will probably come at least a valuation of 27 billion with upside risk to that. So I think in that case, Pick n Pay will not have to sell that much in the IPO. And that means that the rest of the business is pretty much at a big negative value. But there will be a net cash position post of the rise. And they also guided in last set of results that they're going to halve losses next year. And they're actually going to have capital to actually compete to some extent. Now, one thing you need to remember is, I think there's a misconception that people look at the number of stores closed and then they're concerned. Pick n Pay is not trying to compete with market share with Shoprite at the moment. Right? They're trying to clean up their portfolio, becoming smaller, more nimbler. And I think if they can do that, then there is value in the traditional Pick n Pay or corporate stores, which gives you about a revenue of, call it, between 60 and 70 billion. That business is quite valuable if you can operate it decently. Combined with Boxer, which I think has got phenomenal longer-term prospects. I read if you look at the prospectus that is released, that pretty much targeting space growth of 10%. With like-for-like growth there, 5-6%, and then looking at 15-60% compounded revenue growth. That's very, very strong. So I think the market will pay a top premium for that business. So I think a combination of the two be good, but more importantly, Sean Summers, the CEO, will actually have some money to fight with to try to turn around that business, which will not be easy. But I think he was pretty much the only CEO that was at least on the same page as Whitey was on back in the day. So I'll rather give him benefit of the doubt than bringing in some foreigners and so forth like done in recent past.
All right. Well, thank you so much for your time and for your analysis today, gents. That is all for tonight's Stock Watch. Thanks to our guests, Alex Duys from Umthombo Wealth and Drikus Combrinck from Capicraft. Up next, The Close. Stay tuned.